Yo, what's going on, everybody? This is Tuesday TVs with Sang Lucci. We're here with Brian Weiner out in the New York office, and today Brian and I are going to talk to you a little bit about how volatility, okay, sort of the what's the Greek terminology for your vol reading?
Well,
Right.
the vega of an option, its sensitivity to a change in vol.
Okay, so we're going to talk to you a little bit about how that affects your options prices. Okay, a lot of you guys do your research on a lot of the Greeks here and try to incorporate this kind of way to figure out why your options are priced the way they are. So we're going to go through a couple examples here real quick on Tesla and Netflix, where you can use volatility to explain what's going on in your option. All right, and just a quick synopsis here. Everybody was trading today. You saw some big spike ups off the open. People that were getting bullish here, market going to all-time highs. And a lot of sort of desire for call options. And we're going to start off with this Tesla here. Brian, did you trade anything today? I'm going to pop up this.
Uh, Unfortunately, no, because I would love to as a vol trader. About a day away from starting my market making year for
Cool.
Sang Lucci.
Cool, cool. So here we go. We got this Tesla 245 weekly call, and Brian is going to tell us. Brian is going to take us through this thing and show us where vol really affected the option. So take it away, Brian.
Yep, yep. So you see on the spike open
Right,
in Tesla, the 245 spiked up dramatically,
right,
to 3.5, 375.
right.
What you have, this is just a nominal price chart, but what it was is that this option price extended greater than its delta. There were people coming in, they wanted to buy some calls, some out of the money calls. It looked like Tesla was going to have a big move,
Right.
and then it reversed in like 6 minutes. So you,
Okay. Yeah.
yeah. So you see the reversal. You see a reversal. 15 minutes into it, not only did the option dip down because of the delta component, but the volatility. There were people that bought a whole bunch of calls. They realized they did the wrong move, and they started all trying to sell it out at the same time. Now,
Okay.
let me show you one other thing. You see in say that third or fourth candle, there was stability there. There was stability in the price, but there was also stability because the volatility started going back up. The reason being is that we had such quick moves in Tesla in a short period of time
Right.
that the market makers were supporting that option. The market
Okay.
makers wanted to own options. They wanted the volatility because to them, they're pricing their volatility on a quick, realized move. It was up and down. What was it like? 3, 4 points in a matter of 15 minutes.
Right.
You
Tesla.
know.
Yeah. Off the open. Yes.
hmm
Absolutely.
So it was not only was so the demand. So now in the beginning you have demand and delta bringing the option up, and then later on you have delta bringing it down, but then demand from the market makers. So there's like this juxtaposition. There's like retail guys and then the market makers. So those guys are kind of battling there at that little dip, the third or fourth candle.
Right.
So it's
Right.
very interesting.
Okay, cool. So, can you explain to us, I mean, I envision, this is how I sort of envision it. I take a look at this and I say, okay, if my tape, let's say, doesn't show me that, buyers are really there to support, paying this price and this option, this is when somebody like yourself or a market maker will come in and start selling that option. But you're saying they don't look at it from, let's say, a tape perspective. They look at it from a pure vol perspective, correct? So what is it that tells them, like, all right, it's time to start selling this option?
Well, I mean, it really is part of their pricing model. I mean,
Okay.
they're not going to pay up for an option when the stock is dipping. There's no point in that. You know, I mean, there is a kind of a tape perspective for them. They have, price of an option based on where the stock is. So if the stock is, and this is a problem that you see and other retail guys see, if the stock is very volatile, these
Right.
market makers widen out.
Right. Absolutely.
because
Absolutely.
they have to hedge. Now they're willing to take the other side of your trade. They probably are willing to sell um, those calls at that spike. Even though it's kind of volatile, if the market kind of tightens up a little bit, they're
Okay.
willing.
And when you say the market, are you talking about the bid and ask for Tesla specifically, or are you
Yes.
talking about the index?
Yeah. No. The bid and ask for Tesla
Okay.
specifically. You
Okay.
know.
Okay.
So
So
as
things
long as
tighten up.
yeah.
All right. So then you were saying, as this thing starts to dump, this is now sort of a delta move here. Tesla was really selling off, selling off, selling off.
Mhm.
But then what happens down here? What happens down here? The stock kind of is still moving, so there's still a lot of volatility in the stock.
Mhm.
But then what's going on with this option?
Well, so the complexity of market makers, some of them the better ones, they're kind of determining if they want to buy or sell an option based on not only the volatility of Tesla but the volatility of the market. It's kind of correlated. Their demand for an option or their supply to sell it to you is kind of correlated to what's going on in the market as well. And so as SPY is dipping and Tesla's dipping,
Right.
well, it's a more volatile environment. So as you can see
Right.
at the end of the day, these options should be coming off a lot more than they did today
Right.
because of the time decay. But because Tesla was very whippy, it was very volatile, and
Right.
SPY was dumping, you can see that those prices actually plateaued.
Okay.
So
Right.
that's like a market making volatility curve aspect of an out of the money call. The volatility comes up a little bit as we're dumping down
Right.
because that's how market makers price their options.
Okay, so I mean, in that sort of analysis there, I mean, when would you come into this option and start selling aggressively just by looking at your volatility curve, so to speak? I mean,
Well,
when would you come in and start really just saying, all right, I'm going to sell the shit out of this thing because
yeah,
she's going to nothing?
good question. And that would be around 1 o'clock. We started just oscillating around.
Okay,
There was like a mean around. I think the price around 234, and we were just chilling.
right,
You know, and so there are kind of like some peaks in that option. And everyone they were selling it around $1, kept selling, 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 sell it
yep,
down.
yep,
And then Tesla, dipped down even down to like 231 and change. But
right here, she
yeah,
dumped down to about 232 or something like that. Yes,
yeah, but the actual option was plateauing
right.
because of that volatility. If you bring up that little snippet that we.
Oh yeah, yeah. So Brian went ahead and sent me a little sort of screen share from his market maker platform, and we're gonna go ahead and share that with you guys right now. Give me 1 second to pull it up here. What do we got? Here we go. All right. So Brian, go ahead and explain to us what are we looking at here.
Right.
Um,
So you can see the second column from the left, the 245 strike. It
okay.
says plus 121.
Okay. So we got 245 strike here.
Yep.
We got plus 121. Okay. What are
Yep.
we looking at?
Yep. So what that's saying is, at the end of the day, and that was after the close, that actual option, in terms of volatility, kind of went up, you know, over the course of the day.
Okay.
So the volatility, if the long story short, if you bought those calls and hedged them
Right.
from the beginning of the day to the end, you would have made money.
Okay.
The volatility came up in those options. The point being is because of what was going on in the market, what was going on in Tesla.
Right.
We were dumping down, and people were buying calls because they were selling stock. It's a very repeatable um, situation in the market, and that is what causes the vol curve to actually come up. It's just a fundamental um, tradable event. You
Okay.
know.
Okay.
Yep.
So when you're saying actually a sort of tradable event, what is the actual trade from the market maker perspective? Like what's the actual trade? Is he buying that volatility and then shorting the stock, or what's he actually doing?
No, he's not. But here's the deal. So there's two
Right.
different sides. There are people that buy those calls to hedge against their short stock. They shorted stock and they buy that as protection. Okay, that's one. That's the retail side. Okay, from the market maker side, if you if a stock is dumping, okay, and you sell a call and you hedge it, okay, and it's a big move,
Right.
the market maker is going to lose money from buying stock as the hedge of selling that call,
Right.
okay?
Right.
And so, especially in weeklies, that's a problem. We talk about gamma sometimes. I try to bring it up.
Yeah.
It's a complicated thing, but if you hedge a call that was a 20 delta and now it's a 10,
Right.
you're losing money on that hedge, okay?
Absolutely.
And that option isn't decreasing in value because it only has a smaller delta now. It has a 10 delta.
Right. I've seen that. We've seen that happen to me quite often when we're hedging into things, and now we need another strike or we need something else to support what's happening.
Right. So it's kind of just a fundamental. It's the physics behind the option market, and in concert with the stock market. So
Right.
we could do that another time if you want to have a more
Yeah.
advanced class. But
Sure.
what happens is that vol curve on the call wing, the out of the money call wing, comes up a little bit because market makers don't want to sell calls, buy stock, and the stock dumps because they're
Right.
going to lose more money
Right.
on that stock hedge than they are on selling that call.
Right, right. Is there any way, and just to bring in like the sort of the manipulation side of things, like let's say they find themselves in that situation, what are some ways that they're able to mitigate that sort of risk? Are there any sort of tools or tricks in the bag that they have that will help them sort of coast out another day so they can get out of the position or
Yep.
coast out another week or something like that? Like, what do they got? Like, what can they do?
It's quite simple actually, and I'm actually going to be doing that as well.
No
You can
doubt.
you can set in your different delta ranges of strikes. So maybe from 0 to 10 delta, I'm only going to hedge half of that option.
Okay.
Okay, so I'm only going to buy half the amount of shares of stock.
Okay.
So it's kind of like pre-hedging having to sell stock lower.
Okay.
Okay, so it's like I'm only going to buy half the amount of shares, and if we dump, that's great because I didn't buy the full amount of shares I was
You
supposed
didn't
to,
exactly. You didn't get the full hedge, so to speak.
and that's what they do. Or they
Okay.
hedge it with a smaller delta. Say you buy calls and we go up. Okay,
Right.
if a market maker buy calls, they have to sell stock.
Right.
Okay, and if say it's a big rip, well, not a big rip, a slow rip.
Right.
I have the option of saying I only want to hedge half my delta, so I let basically half of the options that I bought are hedged and half of them are not.
Right.
So I don't sell too much stock too low, and I let
Right.
half the options ride.
Okay.
And that's what I'm going to be doing as well.
Okay, you know what, and that leads me to another question here, and we'll kind of end it here. I mean, just so that like everybody out there, they don't really get too much perspective as far as what the market maker is looking for, and then what kind of decisions, the market maker has to make, and then what he's looking at to sort of make those decisions. So, how much is delta? How much is the stock actually moving? Really a factor when it comes into your, let's say, market making decisions here.
Yeah.
Are you making more decisions predominantly on your sort of calculations as far as vol goes, as far as, vega, gamma, things like that, versus what the actual stock is doing? Like, you know what I mean?
So okay, that's a good point. So if the
So let's,
stock,
I mean, let's just go back to that Tesla. Let's go back to that Tesla. You see this Tesla dumping,
Mhm.
and you're a market maker, right? You got to provide this liquidity. Let's put yourself in the hands of, let's say a DMM for Tesla, who's in
Mhm.
the options market, right? Who has to provide this liquidity. He's out there selling. Assuming retail wants to come out there and buy puts, right? Because they see the stock going down. What is he doing to still make money on that trade? Obviously, he's losing money selling puts to retail,
Mhm.
but what's he doing to still make that money back? You know what I'm
Yeah,
saying?
that's a good point. Now, if you sell it at a very low vol, that kind of sucks because as we
Right.
keep dumping, the vol comes up. But say the vol was kind of higher than normal, he sells you that put. He's hedging. He's selling stock. It's actually really good for him because he's gonna if the delta goes from like a 50 delta put to a
Right.
60 delta put,
Right.
every 5 deltas he's gonna sell more stock against that. So he's
Okay.
gonna delta hedge that position.
Okay.
And so if we go down, say from like 11:30 to 1:30, we go down and it goes from 50 to a 60 or 65 delta. He's hedging the whole way down.
Right.
Then down there, the vol is actually going to come off. It's
Right.
going to come back down, and he made money on that hedge the whole way down.
Right.
Okay, and so he maybe sold the vol at like a he sold that option with like a 51 vol, and down there it's like a 52 vol, but he made money on that hedge. He made money on some time decay, and if it just
Right.
sits there, that vol comes back down to 51, maybe even lower.
Right.
So he's kind of just like selling stock the whole way down as his hedge to that put, and he's making money on the put because the vol comes back down, and on the
Right.
stock because he sold stock the right way.
Okay, okay. Well, that's pretty cool. I think there's some good takeaways here for retail on that sort of perspective. One last question, just throw it out there, is that how much do you think he's involved in the actual delta move of the stock? I mean, if you had to put a weight to market maker hedging
Hmm.
to the length of the move, to the severity of the move, to the whole sort of exaggeration of the move, right? Tesla moving down 10 points
Hmm.
versus Tesla moving down 5 points. Would you really put emphasis on how much a market maker can move the stock just by hedging, and then what particular stocks can they really move it by? I mean, I'm assuming the lower liquidity, the easier it is and the more exaggerated that move is, correct? Because these guys are out there hedging and all that kind of stuff. So I don't know. You got comments on that?
Yeah, definitely. Some stocks, the option hedging is 30% of the average daily volume.
Okay.
Now,
Okay.
if you have a guy like you that is seeing a move, it's reading the tape, and you're like, I'm going to buy a bunch of puts,
Right.
you're kind of increasing the average daily volume in the options.
Right.
That
Indirectly, because that market maker is selling that volume to me, and he's got to go in the stock and hedge.
Right. So not only are you increasing the volume in, say, the beginning of the day by buying those put options, and he has to hedge it, you know, you're see because you're seeing the tape, you're seeing sellers,
Right.
and so it's already going to be an above average day in volume possibly in that name.
Absolutely.
And now you're buying puts, so there's
Right.
going to be and you're kind of increasing the average daily volume in the options, so that's going to in turn increase the volume in the stock even more because that market maker has to keep hedging the whole way down.
Right.
Right. So it's almost like 2 3 times um, as effective as just like a whatever day in the market.
Right.
So
Right.
you're increasing. You are reading the tape in the beginning. You're buying puts, and then that guy's selling more stock. So it's like the average daily volume might be 2 times the normal.
Right.
Today's volume might be 2 times the average daily volume because you started off reading that tape.
Right.
So it might be a day where option hedging is 30 40%
Right.
of the average daily volume of that
Right.
stock. You
Right,
know?
right, which is nuts. And you know what? I think we just found a cool little thing for you and I to do, just to really talk about some of the times that I take my big trades, and then you being sort of the market maker in this aspect, like watching me take these big trades and seeing scenarios where a market maker will make a sort of decision based on what's going on with volatility, based on what's going on with the actual stock and everything. And I think the two worlds combined here, we might be able to bridge the gap here and figure out a cool sort of equilibrium where the retail can understand, like, okay, what is the market maker doing here? This is why I'm seeing this sort of price action. And then maybe they can sort of take that extra step to figuring out, like, when putting on that real size is really sort of the timing for it, because as you know, like, that's one of my biggest issues, right? I mean, the timing for some of these moves,
Hmm.
getting in front of large sellers or large buyers. The question is there follow through? Is there sustainable activity here?
Right.
And I want to ask you, let's end it off with this one, is that, when you see those big delta moves happen in the market, right? We see them happen very few and far between, you'd say a 1 out of 10 times, the market really makes this big, gigantic move and everything sort of moves together. What is the market maker doing at that time? Are they also playing the move too? Like, will they ever play delta too?
Yeah,
So
some
in other words, are they pretty much out of the selling options game, and do they actually come in and buy options? Like, do they play that move?
Yeah, I mean, here's the deal. Like some guys that have the wrong position on, some market makers will have to step up and get out of their short option position, their short vol position, and they will do that. Other times, if they're selling a put, they're buying a call and they're hedging that,
Right.
so they're equalizing their short vol position by buying, say, a call because someone wants to sell a call and they're
Right.
with edge, so they're like, great, I'll buy that and I'll sell stock,
Okay.
and my volatility now is kind of hedged. I'm short put, long call. I'm short stock now. Market makers, option market makers have to be diligent, and I am going to be as well about not building up too much hedge inventory. I don't want to keep
Right.
buying stock as my
Right.
hedge,
Right.
or selling stock as my hedge. So that's
Right.
something you got to worry about. But oftentimes there's paper somewhere else. There might be a guy that thinks that this is the low. It might not be, and he's selling his puts out now. And
Right.
a market maker's like, great, I'll buy him. He might take, or he'll wait for that guy to come in and
Right.
hit him on a little pop. So a market maker's just waiting. He's there for buyers and sellers. I'm here waiting for different types of people to come in, and hopefully my volatility is evened off and I collected edge the whole way down.
I see. I see. All right. And dude, we keep going because you keep kind of spitting out these little gems here that I know everybody wants to understand. Is there ever a period in time where a market maker just does horribly? Like, can you think of a market environment where a market maker just gets run over every single time? Like, is there, are there those periods where the market maker is more at a disadvantage than the other players out there?
I mean, yeah, because they have to hedge. If you're there's different types. I mean, there's different things they have to look out for. The stock and the volatility. So when I was at Trading Machines, I had a
Yeah.
cool little tool, and we're almost done building it here, and I could see, if the volatility is too high or too low. And I wasn't really a market maker at Trading Machines. I was like a pseudo market maker. I
Right.
didn't have quoting obligations. So if the vol just drifted up too high, I would just slam the whole market, and the market makers are just eating it.
Right.
The guys in Amazon, the Amazon market makers, I think they're Susquehanna, they would actually try to put it in my face and like say, F you, I'm going to still raise the vol even though he sold it to me. Over
Right.
time, that doesn't work out for them.
Okay.
Now, when you have an oscillating market, and you're selling calls on the high,
Hmm.
you know, because you see like a big seller on the stock, they might not get their stock off, and they might be buying calls that look like they have edge, but they lose the edge because they can't get the hedge off,
Right. Right.
and
Right.
that's when you sell an ETF against it.
Okay.
It
Okay. So you're even hedging the sort of hedge, so to speak. That's what
right,
you're selling the ETF against the hedge position, and that affords you the ability to give you a little bit more time to work out of these positions, right?
exactly.
Okay. Okay. I see. I see. All right, guys. Well. Listen. I mean, dude, Brian. Honestly, like, we need to have more of these conversations. So
I'm
let's
here.
shoot to have we'll shoot to do this thing again Tuesday, guys. If
Yeah,
anybody has any questions whatsoever, remember we are taking questions here live. So if anybody has any questions, shoot us out on Twitter, and Brian and I will sort of stomach this for next Tuesday. Um, Everybody's very interested to know what you're doing for what you plan on doing here for Sang Lucci here. I mean, so you're gearing up to start trading here,
yep.
and your strategy is going to be predominantly sort of the market making strategy here.
Hmm.
I mean, where do you see this going? What names are you trying to play? What's your deal?
Right. So I am sticking with the high flyers. The high flyers have a lot of volatility. It's a vol of vol. The volatility fluctuates like a stock.
Right.
And so, my game is to play as, a good handful of names: Tesla, Netflix, Goog, and Google, which is a
Okay.
fun combination, and Amazon. Those have been
Okay.
moving around quite a bit. You know, um, a lot of opportunity to buy cheap vol, and just like Tesla or Netflix, especially Netflix, because that even had a greater move today. You know,
Yeah.
you buy cheap vol. Some market makers are like lowering their vol because it's not moving. I buy it on the cheap, and then Netflix dumps. What did it dump? It dumped 8 points.
8 points. Can you give us a quick and dirty example? Just a quick
Hmm.
and dirty example for retail out there. When you say
Yeah.
buy cheap vol,
Yep.
what is that? What does that mean?
Okay.
When you're out there buying cheap vol, just give us a quick example. Like
Okay.
what does that mean?
Okay. So,
Just
time to
give us an example on a
uh,
strike that you might
that's
buy or something like that.
I'll do it right now, real
No
quick.
doubt.
So Netflix kind of just evened out, I'd say, between 130 and 230, 245.
Right.
Nothing's really going on. The vol came in. Um, so say the 445 call came in like 50 cents.
You mean the 245 call?
Sorry, the Netflix 445 call. I'm thinking about Netflix now. So the Netflix 445
Okay.
call
Yep.
maybe came in 50 cents because we're doing nothing. So, and not only that,
Right.
um, there are time buckets where time decay comes out during the day.
Absolutely.
And you could have caught two different buckets of time decay coming out and bought a 445 call, pretty much the cheapest of the day.
Right.
I hedge it, and it goes from like a 50 delta down to like a 35 delta by the
Right.
end of the day. And so I'm making money on a gamma move. So
Right.
basically, I sold too much stock
Right.
versus where the delta was at the end of the day, and the volatility came up as well. So
Okay.
I bought. So the vol came up, and I made money on the gamma.
Okay.
And I keep staring at that. I'm like, if I bought like 100 Netflix 445 calls
Right.
at 245, I would have made a crap load. I would have made like 30 cents on that option, 3 grand on a 100
Right.
lot. You know,
Right. What were those options trading, by the way? The 445s when you were taking a look at them?
I you know
Was it like
I
30,
don't
40 cents? I mean, it could have been
no
that
no no
much.
no that was at the money. So it's like
Okay.
a 450 option.
Right.
Effectively, I sell it out at like 750
Right.
with given all the parameters involved. It
Right.
wasn't 750, but I made money on the gamma. I made money on the vol
Right.
coming up.
Okay.
You know.
Okay. Really cool, really cool. And guys, I think what we'll do is try to create some infographics here for some of you retail traders to understand some of these concepts. I know for a lot of you it's kind of difficult to sort of conceptualize this and say, okay, speak in terms of things like vol, things like gamma, things like that. Especially even for myself, for me it's just raw. Okay, what is the stock is doing, and that's where I'm making my decisions. To add in all these things and create strategies around them. That's essentially what Brian is doing. So it's very interesting, and we'll tackle this stuff every Tuesday going forward, man.
I have to make a correction though in my
Sure.
calculation.
Go for it. Go
It
for it.
would have been me buying a 450 option and selling it at 480 on a
At
100 lot.
yeah,
Yeah,
480.
not I was big.
750 is like a Sang
Yeah.
Lucci move, right
No,
there.
no,
You know
no.
what
That
I'm
yeah, I was like, I did the math. I'm like, that's 30 grand now. But yes. Anyway,
saying?
still 3 grand on a 100 lots pretty dope when I'm
Right.
hedged.
Right. And again, like guys, it goes even forward to say, the market maker is making it's making smaller, well, not really smaller, but more informed, more hedged type of risk, these kind of decisions to make little money, little money, little money, little money, and not really, again, going balls to the walls and taking that kind of risk that I take. So we're talking about two different worlds here, and it's really cool to see how both of them work, alongside each other. So that's it for our Tuesday with Sang Lucci here. Brian, you got any closing words here, man?
Uh,
You
man,
watching soccer, man? What are you doing with that big ass lip in your mouth there, man?
I was watching soccer. I was actually depressed when we lost. I can't believe, Gamba is so depressed in this office. I bring it up, he starts crying
What? What?
about U.S. losing with 22 seconds left.
Well, dude, we didn't lose, man. We tied.
Well,
We ended up
it was a
tying.
loss. A tie is a
Yeah.
loss in that game. That was ridiculous. That was BS, man. Just waiting
No
for
doubt.
football. I'm waiting for the real football, bro.
Yeah, Brian, everybody is a very avid Pats fan, guys. And again, like I'm a very avid Pats fan too. So we're watching the season real closely here, the drafts and everything. So all right, man. So Brian, let's link back up on Tuesday. We'll come up with something else for these people.
No doubt.
All right, man. Take care, everybody.
Later, yo.